Hi, and welcome to Macro Wednesday. We talk macro and try to make sense of markets that really don't make any sense. I'm your host, Steve Van Meter, and some of you asked, where was the crown on Monday? Hey, the bond market was closed. My friends, don't worry. The crown is still here. So before we get into the economic data and the charts and all that fun stuff and see what's going on in the world of macro, I want to go back just a little bit to Monday's Dr. Lacey Hunt episode, because many people over the months and years or whatever keep saying, look, bond price or interest rates are just going to go shooting straight up overnight. I mean, one day you're going to wake up and they're going through the moon. No. So what did we learn? What is the key thing that you learned from Monday's episode? The federal government has overused debt, overused it. And we look at and we see this happen in Japan. We see this happen in the Eurozone, and it has and is going to continue to happen here, which means interest rates can't just go up. There's just too much government debt. And so some people, well, but they have to go up. No, they don't. Look, at the onset, at the beginning of this, the federal government would have to stop running these massive deficits. Ideally, they would need to run a surplus. And is that going to happen anytime soon? No, not even close. I mean, it'd be different if we weren't in some quasi-pandemic recession that we are now that was chock full of stimulus, candy. But interest rates can't just shoot up. The monetary system, all that government debt that's floating around there, puts a ceiling on it. And I think people just don't understand it. That's just how the system works. So one thing you can take away from Monday's episode is that, and I hope, and at least based on the comments, many of you really enjoyed it. So we will add Dr. Hunt's research on a quarterly basis to the show. And of course, anything that Jeff Snyder says of overly particular interest, which most of the stuff is interesting, but if there's something really interesting, we'll take a look at. Now, I want to get into the economic data. It wasn't anything on Monday due to the holiday, but one thing I found interesting in September, small business optimism went up. In fact, it's not back at its pre-pandemic highs, but it's pretty close. And I find that very interesting that with all these businesses failing, that those that are open are, well, they're rather optimistic, which is great for small business owners. I'm not sure it's the best idea, but many of them are saying they're looking to add inventory and build their inventory. And I'm kind of surprised by how optimistic they are. Now, of course, everyone's favorite indicator on this show is the Consumer Price Index. And on a year-over-year basis, it went up from 1.3 to 1.4%. And that's not that much. I mean, if we look at even the core CPI, excluding food and energy, it stayed flat at 1.7. So I pulled this on the Fred charts for you to see so we can look a little closer. And what you can notice, now again, it doesn't matter whether you like the CPI or not. What you'll notice is the trend of it, the momentum, right? So CPI is rising, but what is momentum doing? It's slowing. It looks potentially like it's maybe even may start rolling over. And what's interesting about that to me is if we overlay the year-over-year rate of change of the money supply, everyone said, oh, look, the money supply is running a 20-some% year-over-year rate, then the CPI has to go vertical. Right? It's like we're watching Top Gun. We're going vertical, Mav. It's like, no, we're not going vertical, Mav. We're going to roll over because there isn't a big relationship between the two. In fact, arguably, you can see rises in the money supply or on a year-over-year basis do not directly correlate with a change in the year-over-year rate of the CPI. So all those people that were talking about, oh, the CPI has got to head higher because of money supply, if that were true, then it should not be rolling over. We should not see that trend starting to happen here. We shouldn't see it slow down. And what does that mean from a money management or an investment standpoint if the CPI starts to roll over and head lower, which of course we know it's going to because the money multiplier tells us it will? What does that mean from the Fed's perspective? Is that bullish on more quantitative easing? Oh yeah, that is bullish on QE. In fact, while we're on the subject of QE, let's go and see what the Fed did with that today, and then we'll come back to the data. So the Fed was set to renew its quantitative easing schedule today. Now, you might ask why I look at that. Well, One thing that this show is kind of a soap opera of my broad thesis. And, depending on what part we're talking about, which mostly is phase one, one thing I want to teach you as you build your investment thesis of whatever it is. It could be your investment thesis, could just be a plan for your life and your family. I mean, you have views and directions you want to go, and then you need to break it into chunks and set those goals and achieve them and make sure you're on the right path. Well, the same is true when you invest. So one thing that I do is always make sure the data hasn't changed. Now, of course, I know if there was going to be a change in this, the Fed would have announced it, right? I mean, we would have heard that. The Fed's very clear about making announcements to policy changes. But I'm not going to leave it up to chance. I want to check and make sure. So here it is, the next 9-day schedule. No deviation from the last 9-day. We've got 3 purchases of long bonds. So tomorrow we'll see another purchase of tips. And then on Friday, the biggest purchase of the schedule is always on short-term Treasury notes. Even though it says 0, they do not buy T-bills. They have not been buying T-bills, and they don't buy anything 4 weeks or less to maturity. The banks made sure they stopped buying T-bills with QE, so that'll be a big purchase on Friday, but the schedule is still intact. Let's go back to the data and look at real earnings. So when you see real, it's inflation adjusted. So real earnings still grew from 0.3 to 0.2% in September, but at a slightly slower rate. That's not really what the market wants to see. It wants to see inflation-adjusted earnings rising because that means you have more spending power, and then consumers will go out and buy discretionary goods and services. How about the Red Book? One thing I like to look at, and I know Chris Dark and I, this is one of our favorite high-frequency indicators, is something I just recently considered is on a year-over-year basis, it slowed from 2.1 to 1.2, and we've noticed that the Red Book is slowing down. But I've never thought of it in terms of inflation adjusted. So is this 1.2 increase in the Red Book when you adjust it for, say, the Consumer Price Index, which I know none of us like or agree that it's accurate to any degree, but let's just pretend it is. Well, wouldn't that imply that on an inflation-adjusted basis, that the rise in the Red Book retail sales is actually declining? Pretty interesting notion there, isn't it? So possibly all we're seeing in retail sales number here is due to inflation. Moving on into the Wednesday, today's data, just looking at Consumer Price Index data from other countries. Let's just go backwards. Eurozone, German CPI went from 0 to -2, so that's deflationary. And I don't think we had any on Monday. Let's go into the Wednesday data. How about, let's see, Spanish CPI still in deflation at -0.4%. And Eurozone industrial production, -7.2%. Again, not seeing a big rebound here in the Eurozone economy if industrial production is running at a -7.2 year-over-year basis. Mortgage applications were down slightly, even despite record low interest rates. There will be a point, now I want you to think about this, there's going to be a point where we tap out all the people that want to refi. I mean, if you think about it, you've got the baby boomers sitting at or in or near retirement. And for some of them, they don't owe a lot of their house. They don't have a lot of years left, so refi doesn't make a lot of sense since they're not paying a lot of interest. So really, we need to see a lot of this lending growth come out of Gen X and the millennials. You got to think that the boomers just were massive users of credit. And as they get older, that gets paid down and paid off, meaning the rest of us have to pick up that slack. And that's one of the reasons we're seeing contraction in credit right now. Looking at producer prices, this did rise mostly due to food prices. So many of you have commented and said, hey, Steve, you need to go to the store because food prices are rising. And one of the biggest subtractors of the producer price index was food and energy, but it went from -0.2% last month, which was deflationary, to an inflationary 0.4%, and the market totally ignored it, didn't even care about it at all. All right, so let's go on to look at what's going on with hedge funds, because we didn't do that on Monday due to our kind of special episode. But I certainly like to go over it because the situation for the bond market got even better. So if we look at 10-year Treasury note futures, we can see in this backup in yields that the speculators are still long. So it's interesting. They're still long, but they're a little less long than they were. What is very interesting to me is we went from the longest short position in the 30-year bond to the now largest short position in the 30-year bond. There was massive, massive, massive bets against the 30-year bond. And I know some people said, oh, well, it's just due to hedging. Yeah, well, we'll see how that hedging works out when interest rates go back down. And, these people that are short start losing a lot of money on that. You normally do not see a bottom in interest rates until speculators are long. And at this level of shorts, if you haven't seen interest rates go up now, you're not going to see it happen. Let's move on and see crude oil. No real change in speculative positioning. Crude seems to be stuck at $40 a barrel, but keep in mind energy stocks have been leading oil down, suggesting that crude oil prices are headed lower. S&P 500, no real change there. Speculators are still long. Euro futures, which again opposite is part of the trade weighted dollar. So people that are long the euro at record long levels here, as that gets unwound, well, that means it's going to put a tailwind behind the dollar. And we look at gold. Again, a rising dollar should be bearish for gold. Speculators increase their positioning slightly as gold has been slowly going down. And NASDAQ short positions, well, they backed off a little bit, but the speculators are still short the NASDAQ. I believe this is mostly due to hedging because the data I saw today said that they're very, very long tech stocks right now. Not a real big surprise. Small caps, speculators went a little bit longer on the small caps, and then dollars still bearish view, still short the dollar. People saying the dollar is going to go down from here when you have these short positions, highly unlikely. If it hasn't happened now, it's probably not going to happen. Again, this puts the tailwind behind the dollar as speculators will eventually move along. And last, for those of you who are looking for a spike in volatility, well, speculators are still short, and perhaps that will help you out when that day comes. Let's take a look at a couple of charts real quick. And we've got the S&P 500 in this megaphone pattern. And, I know a lot of you don't really love technical analysis, but it's certainly interesting to look at. You can see the S&P 500 bounced off its 100-day moving average here in blue, shot up higher, and tagged the top of that megaphone, and looks almost like it made a double top, which is pretty interesting to me. You can kind of see it zoomed out, a little interesting potential. Could this be the peak of the market? Most people don't think so. But if you look at positioning, people are pretty much all in stocks. I mean, all in. Now, how about the bond market? Now, this is, of course, interesting. If we look at 30-year yields, we see bond route, or bond and bond route. But let me translate. It's like Steve's an idiot. Steve's an even bigger idiot. Steve is a ginormous idiot. And yet, for some reason, yields, after crossing their 200-day moving average and speculators going to insane short levels, Treasury yields have gone down. What a surprise. Wait for them to break 1.2%, and then you'll see things really start to unwind for the speculators. An easy way to look at that is on TLT. I've added a new line here. This is what's called an ascending triangle. If you look at the dotted blue line up here, the dotted blue line down here, and this is forming a very long triangle. And if usually, not always, but usually this pattern is bullish when prices break that top line. As I've said before, we were on the launch pad. Launch got aborted. Launch backed on the launch pad, got aborted. Wasn't canceled, just temporarily aborted. And the next time it gets to the launch pad, it'll probably go through. But so I thought it was fairly interesting that despite all the notion that prices are going to go to zero on bonds and interest rates are going to go to infinity, that it kind of held a higher low. So we have a low, a higher low, a higher low, and that is generally bullish. And what did we see? Prices come down here, hit the 200-day moving average, and have pretty much bounced off of that, and now are going to run headfirst into a descending 50 and 100-day moving average. And of course, price needs to break through that. And then, of course, this level up here out of this consolidation zone at around 166.62 to get a real shot at getting back to 172. But of course, what do you know? The Fed is still buying. Credit is still contracting. You could see that in the bank data or the earnings data from the banks. So we already knew that because we look at the H.8. So if you look at perspective of the bond market and you look at the research from the foremost experts on the bond market, you can see bonds are telling us what's going to happen in the broad economy. Financial conditions are tight. And as bond prices start to rise again, it means they're getting tighter. Well, how about for the dollar? I almost forgot we should talk about the dollar. How about for the dollar? Hey, look, it's in a bottoming pattern. I know everyone thinks the dollar is going to zero. It's not. It's not going to happen as long as it's the world's reserve currency. And even then, if it's not, it won't. But you can see what's going on with the dollar. It's holding right at its 50-day moving average. And when you start to see prices and hover around a moving average that's flattening, it suggests that the probabilities are going to slowly increase that dollar is going to go up. Plus, as we've talked about, the dollar also follows bond prices higher. Well, appreciate all of you for watching and your comments and being fans. Be sure to like and subscribe. I love all of you, and we will be back on Friday to see if the credit data is continuing to contract, which of course it most likely is, and what other interesting things we can find in the macro data to keep proving whether I am right or wrong and help you build your macro thesis. I'm Steve Van Meter. Thanks for watching. Bye now. The content of this video provides educational information only. Is not intended to provide investment or other advice. This video is not to be construed as recognition or solicitation by Social Security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Meter. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steve Van Meter Financial.